tonight we are talking about the medical industry, the healthcare industry in Jamaica, and if it is a viable sector for investment, right? So let's look at the perception of healthcare as an investment worthy sector. Is it similar to other industries? Because I kind of feel like a lot of people believe that healthcare shouldn't be for profit because it's necessary.
Okay, so there are two sides to the healthcare equation. There's a side of it being a social good, and there's a side of it being a business. And we have to think about why businesses are formed. So some entrepreneurs start businesses for the sole purpose of generating a profit, but the truth is there are some limitations as it relates to meeting healthcare needs. So generally speaking, healthcare is unique in that it is a sector that addresses needs. It addresses wants in the cosmetic space, but generally speaking, it addresses needs. So let's unpack that. If we're in a sector that is focused on addressing needs and there's generally a funding challenge, either because of a lack of understanding from financial institutions, whether that be investment banks or commercial banks or other traditional providers of capital, number one, and two, many governments today in the Western Hemisphere are facing larger and larger budget constraints. So what you find is that after running deficits for several years, that's fiscal deficits for several years, meaning that these budgets have had to rely more and more on debt. The challenge is that many governments are not able to afford to fund the healthcare services sustainably on their own, which means that critical infrastructure becomes underfunded in a chronicle fashion. So when there's chronically underfunded healthcare infrastructure, it means that that healthcare infrastructure starts to wear down in terms of quality. We've seen it in the hospital systems. You've seen it in a lack of fleet size in terms of ambulances. We've seen it in a lack of care, underfunded staff, in terms of low wages, etc., etc. So what that does is that it gives us a backdrop for the need for private capital to fill that funding gap in healthcare. And that's where investors come in. They provide private capital for various atmospheres, but right now we're talking about healthcare. So we've given some context, but let's take it a step further beyond the limited funding base of governments today in today's world, because inflation doesn't just affect consumers, it affects governments. So because of that funding limitation from governments, and because there is a basic need for healthcare in general, let's talk about the case for demand. So we've dealt with the funding limitations. Now let's talk a little bit about healthcare demand and the healthcare demand that is likely to come. So Stuart, in the previous segment, highlighted the importance of population aging, and not enough attention is drawn to this because it's a very unsexy topic. What is population aging? It means that for every person that dies, there aren't enough persons being born to replace those individuals. So what you find is that every time there's a distribution of the population, there are more and more persons bundling up under the older category and not the younger category, because populations always have what is called a distribution, and the age groups are not distributed evenly. So because there has been many years where what they call the replacement rate has been too low, so we haven't had a high enough birth rate to replace all the persons who have died. Most of the persons who are surviving are older, and that's a very simplified version of population aging that we can discuss, and it's a phenomenon in the Western Hemisphere. So it's in the US, it's in Canada, it's in the UK, and also affects the Caribbean. Jamaica is facing population aging. Barbados is actually worse than Jamaica in terms of population aging. So what does that mean? It means that the demand profile of the population will change because it will give way or give rise to the development of the silver economy. That means that consumption patterns are going to change. So the way people spend changes. So what you find is that younger persons, they spend a larger share of their income on building because they're in the growth phase of life. So focus on acquisition of assets, focus on acquisition of not just material items, but educational attainment, more self-actualization. But as someone ages, the way they spend is different. So they focus more on succession, transferring of assets, also improving healthcare and trying to sustain one's lifespan. So as someone gets older, their probability of dying is higher. So a larger share of their wallet will go towards extending their lifespan. So what we're saying is if a larger share of the population is aging and older persons tend to spend more, yeah, no, it's the dog, you call the dog M16, sorry. That's actually Spike. I'm kind of miserable tonight, but I soon deal with him. Sorry about that, guys. So because a larger share of the population is aging, and a larger share of persons who are aging spend more money on extending their lifespan, what you find is that healthcare spend overall in the Western Hemisphere is likely to grow outside of the factor of inflation and all of these things. So even if inflation wasn't an issue in the healthcare space, we would find that healthcare demand alone would push the demand for healthcare products and services in the future. So it's a large study in terms of the development of the silver economy. And what it does is that it creates a large bull case for healthcare based investments, even though it's not a popular topic. There's also rising obesity rates. And what's interesting is that outside of population aging, more than 7 out of 10 causes of death of persons in the Western Hemisphere are all related to non communicable diseases, meaning
Mm.
that heart attacks, we're dealing with complication around heart attacks, which is different from the heart attacks themselves, high blood pressure, cancer, all of these illnesses combined are are responsible for the bulk of the deaths that happen in the Western Hemisphere. It's actually not violent crime. Violent crime is far down, like number 15. So in terms of 70% of the top 10, it's all tied to health related issues. So all these things combined all create a very strong bull case for healthcare.
Yeah, so bottom line, there's a lot of money to be made in healthcare. I like that you mentioned the silver economy as one that we should be paying attention to. I remember as well, Julian, I think it was probably end of last year, or during one of our year-end reviews, either last year or the year before, I was looking at the top 10 um, companies with the highest return in the US, and like five of them were in healthcare.
For
A
sure,
lot.
Khalila. Yes. So even outside of what we call the COVID trade, where many companies significantly benefited from COVID spending by way of vaccines and, of course, other services that would have seen a demand in spike in demand, I should say. We're talking about a larger trend. So we've spoken about the funding gap, we've spoken about the demographic shift, we've spoken about the health issues that are already underway, which we expect to continue to deteriorate. Why is that? What we've noticed is that as technology advances and we spend more and more time inside, we have a higher incidence of healthcare related incidences. So, what you'll have is a deterioration in mental health. Persons aren't spending enough time with each other. You have higher cases of depression being reported, greater complications around personality disorders. Of course, persons are not exercising enough in general. So, all of these things combined create a myriad of opportunities. But what are the main avenues for persons to actually take advantage or at least consider healthcare investing? So, there's big pharma, so these would be the providers of medicines, pharmaceutical products and services like Eli Lilly, CVS Health, and also United Healthcare. These are companies that are listed on the international market. There's also Pfizer. There are also medical device manufacturers, and also there is the biotechnology space. So in biotech, it would be an earlier stage of investing than in big pharma. So big pharma focuses on medicines that have been approved by the FDA, the Food and Drug Administration in the US, that have passed clinical trials and have been approved. So these are late stage medicines. But there are medicines that are not yet approved. And what investors do sometimes is to take bets on medicines that can be approved later on. So, for
Mm.
context, Indus Pharma actually has a medicine that is about, it's actually in the pipeline, it's pending approval by the FDA. So, Indus Pharma generally would be our equivalent of Big Pharma, but it also has a biotechnology aspect to it, in that there are medicines that are not yet approved in the US market, but they might be approved in other markets. And when these medicines are approved in the US, it means that it opens up a large total addressable market for this product. Consumers that have higher spending capacity but are looking for cheaper healthcare solutions, because we know healthcare costs in the US are actually high compared to other territories in terms of the per capita spend. So, what we have is individuals who have high income per capita who are looking for cheap healthcare services. And that is actually a bull case for healthcare tourism in Jamaica, because what you find is that many of the doctors that are migrating to the US healthcare system are in Jamaica. What if more of those medical professionals had practices that allowed similar care to be offered in Jamaica, such that persons who come to Jamaica to vacation can also come to Jamaica to get treatment? What if those persons could recover from a surgery on a beach? So this is another avenue. So what if someone doesn't want to take exposure in stocks, but they want to be an investor in, for example, an eye care business? Or what if they want to co-invest in a medical practice? So these are different avenues individuals can consider. And as we mentioned, it's a long-term trend. It's not something that is a flash in the pan. It's not something that is transitory, but it's here to stay, and it has a lot to do with the world tomorrow. So I don't, just to put the caveat out there, I don't think that healthcare investments are for everybody necessarily. Like all other investments, there are risks involved, and persons should only invest in what they understand. And sometimes healthcare can be a bit dense because it's so scientific, but one can look at co-investing. So, what if you understand the economics of healthcare investing? So, for example, look at RA Williams. RA Williams, they are a business that generally sells to businesses. They are a distributor, and they're what we call B2B. Their strength is that they can form long term relationships and scale by sustaining those long term relationships, have repeat customers, and maybe acquire smaller entities that offer a similar service or operate in a similar space, or maybe operate a similar space in a different Caribbean territory. So they can grow inorganically, right? Um, but that's different from a Fontana, for argument's sake, because Fontana is not necessarily B2B, they're B2C. So they
Mm-hmm.
sell directly to consumers. So it's really about understanding not just, okay, this entity sells medicines or they sell medication, but where do they sit in the supply chain? What is it that they do in terms of creating value for customers, and what generates the most volume and what generates the most value in terms of profit margins? What we'll find is that the entities that have the highest profit margins are the entities that make the medicines or have a relationship with those that make the medicines. Because
Mm.
that way,
So,
right?
like a R.A. Williams, a distributor.
Well, yes. I would say that if it is that R.A. Williams had a sister company that made medicines, their margins would be bigger. If you just
Mm.
distribute alone, then the margins would be smaller because you're
So,
just
like a
taking a markup.
Lasco then, because Lasco makes some of the generics and they sell.
Yes. And even Indus Pharma, because Indus Pharma has Biopress, which is in India. So Biopress is a sister company that's in India that would make the medicine for cheap and then sell it in Jamaica. And then because the sister company, the markup wouldn't be as large. So that's the key to understanding healthcare. It's not just understanding the science of healthcare, but also the economics of healthcare. So I always get into a debate with my friends about it.
So
There's
Sean says this is why he can't understand what's causing medical stocks to struggle to grow on the JSE.
Boy, Sean, it's really because healthcare is not sexy. It's a bit
Mhm.
dense. It can be seen as academic, and of course, many persons are not enticed by by that. Who wants to read medical journals? Anyway, what
Yeah,
I'll
because
say is that
you have Indies, you have MDS, you have
there's
was it
right
Apex? Which one was the one the
is
radiology that
Image
recently
Plus,
listed? You
Image
have
Plus.
even Fontana, which strangely enough, even though they're Fontana Pharmacy, I don't think of them as a pharmacy. Like when I
Yeah, because
because they sell so
they
many
know it's
other
not
things.
sexy. They
It's
know
not
it's
the
not
first thing
sexy.
that comes. Like what the other day, I had a prescription to fill, and it didn't even occur to me to go to Fontana, even though they're a pharmacy.
Wow,
And
talking
Fontana was
about
closer to where I live because
yeah,
in my
talking
mind
about being
it's
an
a
enemy of
department
success.
store. But yeah, so it like you said, not necessarily sexy to invest in healthcare, but the profits are there.
Yes, and some of these businesses have very high free cash flow. So what that means is when we look at the operating cash flow a business has and how much is needed to reinvest in that business to keep it growing or keep it running at a given rate of production, we want to see that the business is not very capital thirsty because some businesses are more thirsty for capital than others based on the model. So, what do I mean? There are some businesses that are able to generate, let's say, a 10% return on capital, but the need for reinvestment is very low. But for some businesses to generate the same return on capital, the need for reinvestment is high. So what we find is that businesses that have very high needs for reinvestment or businesses that are more capital thirsty, they have less free cash flow. And businesses that have less free cash flow have a smaller ability to pay a dividend. So what we like is businesses that have high free cash flow, strong competitive advantage, and that will allow them to pay dividends sustainably and even grow that dividend over time. Because we want to invest in businesses that borrow because they want to borrow and not because they have to borrow. When you have low free cash flow, it means that you're borrowing out of desperation, not by choice. So, for instance, when we look at a Wisinco or when we look at a Last B, let's stick to healthcare. Okay, let's look at Last B. Let us look at, for example, Image Plus. I mean, I know Image Plus is doing a very large amount of expansion in terms of physical expansion. But prior to that, and in a more normalized fashion or context, the business has very high free cash flow potential, which means that the capacity to pay dividends and the capacity to make money without borrowing continuously is very high. So we like businesses like that. And by the same token, those businesses have the ability to chart their own course and to make acquisitions in a way that is more comfortable. Because if a business is struggling with debt just to keep going, then the ability to grow inorganically, meaning to acquire other businesses, is very difficult. It's more constrained because more of your budget is taken up by borrowings. I think R.A. Williams is one of those businesses that can have high free cash flow ability once they keep their costs under control. I think some of the challenges that we mentioned earlier around working capital was really it was really sensitive to what was happening at the time. So a business like R.A. Williams is very sensitive to supply chains because they are a distributor. They don't produce that much. So what it means is that if they can't get product in very quickly, they have nothing to sell.
Mm-hmm.
So if it is that there are supply chain challenges, i.e., supply chain challenges, so if you have a difficulty getting supply and it's threatening the business, you'll have to buy extra inventory.
Yeah, they spoke about that at length in the prospectus, and I was asking Audley about it as well because that happened during COVID. They had supply chain issues. They couldn't get inventory. Panama Canal dry up. Nothing is coming in. It was a nightmare. And so their solution to that was to have more inventory on hand,
Yeah, they don't have any choice because, again, if you don't have any product to sell, you don't have a business.
which takes a lot more money because now you
Right.
have to buy all this inventory up front.
And you won't be able to set, you won't be able to collect cash, from your customers, or you won't be able to collect cash from your customers fast enough to offset all that extra inventory that you had to buy to stay alive because of the supply issue. So what will suffice in the interim is to borrow more because not all of the cash is going to come from just selling the product.
Hmm.
So a lot of times you have to put these things into context. The truth is the business was satisfying a funding gap because of what was happening on the back end. It's not as if they were just borrowing for irresponsible purposes. So I think that the debt burden they have, once that is normalized by way of using the proceeds to wipe out the debt, then we should see a much better performance given that all else remains in place in terms of management controls.
You have a lot. We have a few questions for you here, Julian. Christopher, well, this one is a comment. I think when Caramed comes to market, they will be a game changer. Caramed has plans to list? I don't remember if I heard about that.
Yeah,
Learn,
they
Grow,
do.
Invest. They do? Learn, Grow, Invest wanted to know what's the outlook for the imaging companies on the JSC?
Okay.
That's Apex and, well, what's the parent company called
Apex
again?
and Elite.
Elite, yes.
So the outlook for imaging companies is in line with our previous discussion in terms of looking at healthcare infrastructure and healthcare infrastructure being underfunded. So there's a great need for imaging services because the hospitals and the medical centers can't produce all of the images on their own. So they have to outsource because of the funding gap that is in the public healthcare system. So what happens is that these hospitals and medical centers will outsource to an elite or outsource to an image press to do the imaging for them and send the feedback to the hospitals. So because of population aging, because of the issues about around non-communicable diseases and how prominent they are in terms of cause of death in the territories in the Western Hemisphere, imaging is extremely important and it's needed for almost everything. The challenge, however, is that many of the machines run on voltage that was not designed for the Caribbean. Many of these machines are from Europe or they're
Oh,
from, right, they're built for markets that run on a different voltage. So when they start running on the Jamaican current, sometimes the machines trip out and cause machine failure.
oh,
So
so it mash up the machine.
right, because the machines were not built for our voltage system. I'm sorry for the engineers on the call, and I'm not using the right terminology. Please forgive me, but it's really an issue of voltage that has caused a lot of the challenges around machine failure, and it really has to be managed. So, separate and apart from the sheer volume and the demand that's coming in, there's a discrepancy as it relates to the voltage and what the machines are made for. So there's a way to actually adjust the machine so that it can adjust to the voltage that we have in the country. But a lot of the times, it's it's an afterthought. Nobody really thinks about voltage really. You kind of just want the machine to work, and it will work for a period. But if it's not built for that grid, then it's only a matter of time before the machines fail. Other challenges, lack of expertise around servicing the machine. So all the expertise is overseas. So when a machine fails, the fix is not quick because there aren't many persons who have the parts or the understanding locally to actually fix the machines or service them. And you can't really freestyle when you're fixing medical equipment. You have to know what you're doing. So those are some of the issues. But once imaging businesses can get that under control or minimize machine failure and are able to manage. So there are two things. There's a business of the practice. No, there's a medical side of the practice, and then there's a business of the practice. Once an imaging business, a radiology business can manage both, then they tend to do better. What I've found is that radiology businesses that master the medical side of the practice, but not the business side of the practice, tend to suffer. So they take longer to recover from machine failure, and their numbers tend to look worse than businesses that, or practices, I should say, that have the ability to manage both. So, in my opinion, I think Image Plus has struck a better balance. They have been able to have a good mix of business managers and medical professionals working together as opposed to doctors doing everything. Because there's a difference between having business persons on the board and having business persons in management.
Mm-hmm.
Because the board is not there every day, but managers are there every day. So that is what I get into this debate all the time with my colleagues. That's why sometimes you have to look beyond the numbers and understand the economics of the business and the strengths and weaknesses from a qualitative standpoint. So, for example, Keisha Anderson from Image Plus, she has a business mindset. She would have been hitting targets for many years for JMB when she was country manager of JMB for Jamaica, the Jamaica territory. So she knows what it is like to manage large teams, manage personalities, outfires as it relates to customer service, all of those things. And then there's Dr. Bridgewater working on the back end, who is a medical professional with deep expertise. So you have the two minds meeting. That's where the deficit is for Elite. Elite doesn't have a Keisha. Elite is just doctors.
Mm. Mm.
With all due respect, I mean there's business acumen, but it's at the board level. It's not at
Mm-hmm.
the management level. So they're brilliant doctors, but there's more to a
Running a
listed
business.
healthcare vehicle than being a brilliant doctor.
I say it all the time, in especially when I'm talking to the members of Money Mission and we're doing money mentorship. Like, knowing how to do a particular thing doesn't mean you can run a business that does that thing. Two completely different skill sets.
Yeah, I mean, I really hope, really and truly, it's the machine failures that has been just challenging Elite. But I think to some extent, the systems that could have been put in place, and I don't mean systems from the systems within the context of the machine, but systems within the context of the business. Some of those blind spots couldn't have been dealt with by just the doctors alone. That's why collaboration is important. Um, we can make the same case for GUS. I just think that GUS had a funding mix that was just wrong. It was too much debt. When you look at even the IPO and then how much GUS borrowed in the next 3 financial years, the debt to equity mix was just out of whack because when you have a startup, you need more patient capital, and a lot of the capital was impatient. So when the business should have been starting to hit its stride, it's just like track and field. I don't know all the track and field fans that are on the call, but just bear with me. So
I'm
you know when
assuming
you,
you're in your track and you're in your Jamaica
yeah,
colors.
man,
There you are, ready for
Jamaica.
Paris.
Yeah, that's crazy. Yeah, okay. Actually, this is by chance, but it must be serendipitous. So you know when you start in track and field and get ready, set, go. Runners actually go through a certain cycle. They don't peak at the start of the race. So right as they move off, they have a charge phase where they're pushing and pushing and pushing and pushing and pushing in terms of how much energy they're generating. And they're coming up a curve in terms of their speed. So they're coming up rapidly. They don't peak until they reach about 50 to 60% of the distance. I'm talking about 100 to 200 meter sprint now. I'm not talking about marathon races. So it's just like a business, it's coming up a curve. And when GWS was supposed to be hitting its stride, it had to be using all those internal cash flows to just pay it, so it couldn't reinvest. So the debt that was on top of GUS was just gobbling all of its cash resources such that it couldn't even grow. So the truth is, the debt either needed to be structured in such a way that was more gradual or more staggered or further out in terms of its maturity profile, or it should have been a funding package that just allowed business more breathing room, so more equity, and probably some prefs that were convertible, or just a different funding mix that matched the business model. So the funding didn't match the business model, and that is what killed GUS. GUS could have been successful, and GUS is needed. It's actually a needed. It's actually a needed vehicle in terms of the business case. But sometimes a business case can be killed by the wrong capital structure, and it's very
Mm.
unfortunate. It's like the failure of that business is capital structure one on one. So I say
Mm.
all of this to say healthcare is everything combined. It's not just a science. And sometimes it can be close minded to say, boy, yo, me never pass by you, so when a business about that, Julian, I talk about healthcare thing, yo, that not sound good. Tell me about some patty or some juice or whatever. But there's opportunity. You can co-invest with experts and still be able to do well. Again, you still need to understand the economics of the business, but the economics of the business need to play with the science. So it's both of them combined. And again, even with all of this said, healthcare is still not for everybody. The
Mm-hmm.
risks are real. Like even when I spoke about biotechnology earlier, biotech businesses are very risky. They have a very high failure rate. It's just
Mm-hmm.
like venture capital. Venture capital is very risky. The
So
failure
I'm
rate is
going to ask
insane.
this last question from Harold. Put you on the spot because I don't know if you did these calculations, but Harold wants to know what's a fair market price for RA Williams based on your calculations, barring market sentiment, is the $1 a fair market price?
Okay, so I'll put it into context. First of all, I didn't value it. I didn't value R.A. Williams, meaning that based on my schedule, hold on a second.
Put those dogs in check. So while Julian puts the dogs in check, let me take a few more comments. Sean wanted to
Yeah,
know.
M16, M16 was going a bit crazy a while ago.
Okay.
So
All right. So the price.
right. So looking at it, it might seem as if it's priced rich. Um, it's being listed at a trailing PE that is far above what is on the junior market in terms of the average. However, when we put into context that the debt is going to be reduced significantly, and also the business won't be paying any taxes because it's a junior market firm, it means that the removal of the debt, or not removal, but the reduction of the debt by about 60%, let's just call it 60%. If debt is reduced by 60% and the company will no longer pay taxes, then it means that the upside for earnings is far bigger because
Mm-hmm.
more of the operating revenues will flow to the bottom line. So what that will do is increase the forward PE. Sorry, reduce the forward PE because earnings is going to be bigger in the future than it is right now. Because right now they're paying taxes, the full tax rate, corporate tax rate, and they would be paying X amount on debt because of what we discussed earlier. They need to borrow extra to fill the funding gap due to the supply chain issues. But when we reverse engineer that and remove those two items and adjust it, what you find is a far more attractive valuation in the future. So what we need to think about is how will the business look post listing, not just from the standpoint of the entity winning more contracts, but the significant reduction of debt and the removal of the taxes for the first 5 years. So because of that, I think it's worth looking into. I can't give you a fair price because I didn't value it, as I said, but it's just food for thought.
Okay. Thank you so much. Ingrid says you sound like a real genius nerd.
I'm not a genius.
But
I'm
you didn't
sorry to
deny the
disappoint
nerd
you.
part. That's funny.
Yeah, I can't really deny that though, because long story. Actually, I'll tell you something funny. So originally, I was poised to do medicine. When I was going to sixth form, and my dad, you know, he pulled me one side and he said, "Boy, Julian, there's a subject that if you master it, it will give you everything you want in the world. And that subject is economics." And at the time, we're going through the 2008 recession, and everybody was talking about the economy and all of these things. And I really gave the subject a chance. I followed my dad's advice, and the rest is history. It just took me down this rabbit hole. So what I've done is to combine two of my interests: economics on one side and science on the other hand, more so human science, and really combining the two. But
And
I'm
it's worked.
definitely not a
It's
genius.
worked.
Don't let me let you down.
We definitely appreciate you. You can go deal with your dogs, Julian. Let's not Orville says put on the muzzle.
No man, what
Orville says it's
happened?
a dog fight.
No man, what happened is that you see
Dr.
the
Doom.
dogs have they talk, they talk to each other, and they have neighbors. Just the way we talk to our neighbors, they talk to their neighbors. So they have their own dog conversation right now. So dog will say, "Boy, you hear about Ari Williams," or whatever they're talking about. So you don't get involved
Interesting.
in dog business. That's dog business.
All right. Where my
Yeah.
dog's at. Thank you so
Yeah.
much, Julian. This was a great conversation.